How do you account for the issuance of stock options to the employees of a company? Well, to start with, stock options are in essence a form of compensation. You are awarding this option to the employee such that in the future they can exercise that option and purchase on ownership interest in the company. Well, the interesting thing about stock options is that they are issued at their current value, meaning that the current value of stock, that's the value at which the stock options are issued. So in essence, it has no value at the moment. That is, unless the value of the stock goes up, the value of the stock option remains the same or has no value whatsoever because it's just a right to purchase the stock at that given price. Now, in the future, when the value of the stock rises and you still have the ability to purchase the stock at that lower amount that is identified in the stock option, now the stock option has become valuable. So in the future, the value of the option will be based upon the value of the stock. Now, it's not always easy to determine the value of the underlying stock. You tend to have to hire specialized practitioners, accounting firms that can value the company so that you can understand the value of those options in the future. Oftentimes they use complicated methods like the Black-Scholes option method to determine value, or it could be a revenue-based or a market-based valuation method. So, but anyway, with that being said, at the time of vesting, that is, the stock option is awarded at one point in time, but it does not vest. The ownership interest does not become the employees until some point in the future. Okay, that's called the vesting period. So at that point in the future, the employee then owns that stock option. At that point in time, that's when the company has to record the value exchanged in the transaction. And so assuming that the value is changed, at that point in time, let's assume it's gone up, the company would debit a compensation expense. Now this is on the income statement, right? This compensation expense, and in some income statements that are further segmented would identify this expense as part of cost of goods sold for the development of the manufacture of the item. It could be recorded as R&D if you are paying individuals to develop the product, or it could just be a general operating expense if it were just part of the company's general manufacturing. So any of these things are subcategories that you could allocate this expense to. Now on the balance sheet, because once again you are reducing the retained earnings when the options vest, because you are compensating individuals based upon the rise in value of the option above the stock price, it will reduce the retained earnings of the company on the balance sheet. So you would have to debit the retained earnings account. Now, to make the equation balance on the balance sheet, you would also have to credit the additional paid-in capital account. And what you would credit for is the value above whatever the option, the face value or the strike price is on the option. So if the option strike price is $10, meaning when it was issued, the underlying stock was valued at $10, so you could purchase stock at $10. Now the value of the stock has risen to $15. Well, the additional paid-in capital, the amount above the face value, you would credit that for that difference, $5 per option. Okay. Now, fast forward into the future again, the holder of the stock option exercises that stock option. Now, how do you account for that? Well, you have to reverse some of the transactions. Well, you would debit assets because you're getting cash from the exercise. So when it was exercised, the employee has to pay in $10, right, to purchase stock that, let's say it's still worth $15, would have to pay in $10 and would get stock worth $15. So you debit cash because that goes up. Now, because the additional paid-in capital account was credited previously at the additional value of the stock option above the option's strike price, you now have to reverse that. So you would then debit the additional paid-in capital account. Okay. Now, because these are two debits, to make the balance sheet balance, you have to add a credit. So what do you credit? You add up the additional cash brought in from the exercise of the option, and you would add up whatever is paid out in terms of, or whatever value is it attributed to the additional value above the strike price, and you would credit common stock and the additional paid-in capital. If you do this, it makes the accounts balance. So basically what you're doing is undoing your original entries from the vesting transaction, and then you're finalizing it at the time of exercise. So in summary, that's how you account for the award, vesting, and exercise of stock options.